And good day. Welcome to today's segment of The Power of Money. I'm your host, Michelle Graves, affectionately known since 1976 as the Money Lady, handling all aspects of money from insurance, banking, finance, you name it. Gosh, I've done it. So today's segment is an amazing show, and I'm excited for you to be watching and just sit down and rest yourself and learn some things, because I'm delighted to have in the studio today a gentleman who has been involved in banking as a banker for over 20 years. And we'll be talking about the changing world of banking today, credit, what you need to know to be a part of this changing system. And his name is Rich Ambrose, and he is affiliated with First Financial Bank, which is a regional bank that is with headquarters in Hamilton, Ohio. So I am honored and privileged to have him as my guest for the entirety of the show today. And this is going to be a fast-moving show because we've got so much. Can you imagine two bankers in the house talking about banking and acquisitions and the changing world? And my goodness gracious, what a different time we live in. So without further ado, I'm going to introduce him to all of you, and we're going to get started on today's segment of Power of Money. Again, thank you for dialing in, tuning in, and watching this amazing show. How are you?
Nice to meet you. Thank you very much.
Thank you, and delighted to have you here today. Why don't you tell my viewers a little bit about yourself?
Well, certainly. I've been basically selling something for 40 years. And,
okay.
And you call yourself the Power of Money and the Money Lady, and people have called me the Money Man, but I've been doing this for 21 years. I am with First Financial Bank now. We are headquartered now out of downtown Cincinnati.
Okay.
They've got a building down there, the Chem-Ed Center. And basically been doing this 21 years and do every type of loan there is just about, and have been doing that. And I try to take every person, put myself in that chair, and do what I would do for myself for them. And that's so important in this day and age right now, to do things right the first time.
That's very important.
Not do what's right for your wallet each time. So, and I have a lot of knowledge. And you mentioned credit. Credit is the most important piece of the puzzle.
Well, we're going to talk about that.
Yeah.
And I guess this is just as good of a time as any, because certainly when I started my career in credit, it certainly was not anything as sophisticated as it has become today. The old school bankers, it was a word of mouth, knowing the person, knowing their profile. Based upon credit, we didn't have automated credit gathering, very limited streams at that time. It's 40 years. And here today we have such a sophisticated world of credit. Let's talk about that. What is credit?
Well, credit is how you pay your bills, and if you have credit to start with. If you don't have any credit at all, I guess that's better than bad credit. But credit is when you start as a young person, you get credit. It's documented, whether you have a credit card or a car loan,
okay,
or you've got a student loan or whatever. And the important thing about credit is you have to have good credit today to get a mortgage loan. You have to have good credit to get maybe the same good job that 2 people are competing or 5 people are competing. They're going to look at your credit score. And as you just said, there's more and more and more on the credit report today than there used to be.
Oh my goodness, yes.
There's all kind of things you'd be surprised at. Cross checks of where they got their Social Security number, what state it's in, checking their Social Security number, see if it's right. Soon to be, they're going to be delving into how they paid their rent.
They're going to do verification of rent.
That's what they say.
On an automated basis.
That's what they're going to try to do.
Okay.
And that's kind of something that's just kind of newer right now.
That's interesting. That's very interesting. Actually, it may be a good thing, because many times with young people and they're renting, the process of being able to verify is usually, in the past, had been manual, where you'd have to send out a verification of rent to a landlord or whomever, and there was a potential for fraud in that transaction.
Well, there was a lot of he said, she said.
Exactly,
when
exactly.
When you rent and you're not happy with that situation and you leave, and you owe a month of rent maybe, or what happens, it's bad enough that you owe a month of rent maybe, but if they turn it over to a collection company, all of a sudden you've owed 3 times that much.
Exactly.
That's a whole nother story. But to get back to the credit part, it is so important, because if you make $1 million and you want to buy a house for $1 million, you want to put $500,000 down, if you don't have good credit, it doesn't matter if the house is worth $2 million.
Right. Well, we're back to old style lending, because there was a time, and I was a part of that, where you would look at what we call non-conforming, non-traditional loans, where people, if they had significant collateral and bad credit, it didn't matter, because we were looking at it as a collateralized loan, as opposed to looking at a loan where we're looking at the individual. And so we're back to looking at the individual again. Is that a fair statement?
Exactly. I mean, back a number of years, if you had a 580 credit score, not that I did these type of loans very often at all, but you could get an 80-20 loan, subprime, quote
well, let's
unquote.
Translate it, because viewers do not, we're into banker's jargon,
but,
so let's bring it down.
But kind of, not to waste time on what we cannot do, but the subprime, the non-conforming, we could help a lot of people that were kind of tweeners get into a house. That's kind of lost today. Yeah. We personally at First Financial Bank have portfolio lending.
Okay, now tell people what that is.
Portfolio lending is where, okay, you don't fit the Freddie Fannie guidelines, so to speak, maybe, for a number of reasons. Maybe you get child support, maybe you get alimony, but it's not seasoned for 6 months. So if you have a 700 score and you put 20% down, we can do a loan potentially on that.
Because you're holding the loan in-house.
Right. Okay. And then when they do become available for the Freddie Fannie loan, then we'll take care of it.
You sell it off into the market. Okay.
Yeah, but the credit that I've helped with where my kids go to school and talk to them from the marketing, when they came to my office through marketing, I always told them, I said, what we need at school at a junior, senior year is a credit course.
I couldn't agree with you more.
Because if credit's the most important thing, nobody understands it, neither their parents.
Right.
So the most important thing I can tell you is what I've done with my kids, and all their kids and their friends know it. When they got to be 18 and they're going to college, and they're all through college now. Okay. So when you go get college offers, or you're going to college, or you're college age, you're going to get credit card offers from credit card companies. Yes, yes. That's the time to not throw them away, take advantage of them. What I had done was you get 3 or 4 cards in their name only if you can, and you give them 2, let the bills come to your house, make sure their bills are paid, switch them up, authorize them for you to use them here and there, but switch them up, and after 12 months they'll probably have a 750 score, as opposed to getting credit, maybe 1, maybe 2 cards, not understanding it, running up their debt, and by the time they're a sophomore in college, have bad credit to start with.
That is one of the most horrific scenarios that you've just shared, which is when they go to college, the credit card predators are waiting for them because they're perfect credit. They have no credit.
They're at every stadium. Here, I'll give you a hat.
Here, I'll give you a hat. I mean, I remember when my youngest child was in Philadelphia going to college, and of course she was raised in a very strict credit sensitive home where you pay your bills, you live on a budget, you live within your means, and so now all of a sudden she's an adult, and all of these major credit card companies are soliciting all of them in the stadium. It literally was a thing where they were giving out hats in exchange for credit. And I think about the horrific outcomes for so many of those young people having no understanding of the penalties of abuse of credit.
Well,
what are you going to tell an 18-year-old?
How about if you're giving them information at a stadium
where
there's no security? We have the SAFE Act now. I can't leave any file on my desk if I leave for a minute, much less 5. So how about if you're at a stadium, much less you're getting credit and you don't know what to do with it. How about if your Social Security number and everything about you
that's terrible.
Sitting there blowing in the wind?
Yes, blowing in the wind with somebody that you don't even know anything about.
Exactly.
Period. So your recommendation, to summarize, for at least for young people, is if they are going to college and they get solicitations, that they go on and accept those cards, correct, in their name only, with you as a parent oversighting the process.
Exactly. The important part is to get credit, use it, and pay it off. I didn't say pay interest.
Right.
Because if you buy a pair of shoes and you pay cash and you don't like them and they don't want to take them back, you can't take them back. You put it on a credit card like a Discover, or my son just went to Luxembourg.
Oh, wow.
He didn't, not Luxembourg, Italy, because he was in Luxembourg to see his girlfriend in school from Miami, Oxford, and he had a hotel.
Okay.
And it wasn't what they said. So Discover card just gave him $300 back. That's okay. I don't know if it's okay to say that.
My goodness, I wouldn't
care. It really wasn't what they
that's...
represented. So if you buy a pair of shoes and you're 18 years old and you don't like them and they don't take them back because you paid cash, you got a problem, right?
Right, but credit
if you use
card...
your credit card, they're going to pay you for those shoes whether they get their money or not.
That's
There's so
one of
many
the advantages.
There's a lot to credit, But basically, you want to get one. You want 3 trade lines in this world.
Okay.
3. You want 3 credit cards or 2 credit cards and a car loan or whatever. But you don't have to go out and buy a car to help your credit or fix your credit.
Oh, really?
No.
What do you do?
You hear that all the time.
Yeah, yeah.
Well, let's take the worst case scenario.
Okay.
Somebody's already got bad credit, so when that happens, you got to catch 22. How do you get new credit?
Right.
So you have to go to a bank and sign up for a secured card.
Okay.
And you're going to give them $500 or $750 or whatever, and then that's what you can borrow against. When you put that card out there, if you buy a $500 suit and your credit limit's $750, then that's it. Now then you only got $250 left till you pay all that back, but you're using your own money to back it.
Now let me ask you this, because does your bank do security?
Yes, they do.
Oh my goodness, I did not know that.
Yeah.
I bank at your bank and I didn't know that.
Yeah.
They do secured cards for people. What's the interest rate, may I ask?
That's not my
That's
bailiwick, so I really wouldn't know.
But it is available.
Yes.
Because that's something that I need to let people know.
Yes.
Okay, because so you get solicitations. I know in times past I talked about being careful because people get these horrible fees and interest rates, etc., from these entities that I don't even know the name. They're in North Dakota and odd places, and you're like, well, this is America. I guess there is somebody out there called bricks and mortar. But that's good to know about the availability of that.
Yeah, the important part about that is when you do this secured card business, hopefully you only have to do this for about 6 months.
Yes.
And then the first time you get an offer from, as I tell people, it doesn't matter what the interest rate is if you pay it off. So you get that card when it comes.
Yes.
And then after maybe 6 more months at the most, you're going to get another offer. So now you're going to start picking which ones you want.
Right.
And then after you get 3, then you get your money back from us or whoever. We give you a better card, and you get your secured card back.
You know, that is so wonderful for helping. Now, can young people do that as well as a progressive? If they have no credit, can they do something like that?
I'll be very honest with you. That's all I ever am is honest. I had a young fellow that is very well educated, pre-approved for a mortgage loan. Yeah. But they didn't give him a credit card. They had to do a secured card because their guidelines for credit cards, because there's no security, were a little tighter. Right. Because it surprised me. Now again, I do mortgages. I don't do credit cards, but
But
for years I try to help people get their credit. Right. So basically, yeah, you can get. And the reason I did that with him is he only had one trade line. He was out of college, working at a very good company downtown, very prestigious, but I wanted 2 more trade lines. Right, right. And his scores were strong enough that I didn't think it would hurt him for that situation to go ahead and get 1 card at a time. You obviously don't want to apply for 5 cards at the same time because 5 people are going to pull your credit. No, because they are going to all pull your credit. So in his particular case, he did get approved for a mortgage without having the 3 trade lines. Yes. Well, yeah, and under your bank's internal portfolio? No, that was a Freddie Fannie loan. That was a Freddie Fannie loan? Yeah, he's pre-approved right now and looking at buying a house. That's good. Yeah, $250,000 pre-approval. That's excellent. But people need to understand every bank is different with how they do credit cards, rewards, cash, all this and that and the other stuff. That doesn't matter. If you don't have credit or you have rough credit, there's a lot to credit. Longevity, the type of credit, is it a house, is it a second mortgage, is it a car, is it a boat, is it a credit card, is it a check and go type place, or is it those signature loan type places?
Yeah.
All those go into your scores, but to get off first base, you got to have credit. To get credit, sometimes you got to do secured card, and then get to the point where you have 3.
Okay. So 3 is the number.
That's from my experience. You try to want to have 3 trade lines. And you want to have 3 trade lines that are hopefully over 12 months old if you can.
Okay. Because of seasoning.
Exactly.
And viewers, that is simply a term. Seasoning means how long it's been on the books and you've been actively engaged in using that form of credit. So we're using banker terms, and I want to be very careful because every industry has its own language. And but I want to make sure for the purposes of this show that you're clear and that you understand. So that's what seasoning is. Okay.
And back to, because this credit there's a lot to it. And the most important thing is that one of the biggest questions I have is, okay, my son's got bad credit, but I'll co-sign. No.
No.
You can't co-sign. You can't take perfect credit and bad credit and make it middle credit. You can't do it. Just that's the guideline. You can't do that. So it's important that when the kids are young, you help them to get credit right out of the chute while they have no bad credit and they start to pay their bills every month. If you wait till they're 21 years old or they're out of college and they've got a good job like this fellow did, but he's got 1 trade line, why do that? You know,
right.
And a lot of people that have had rough credit, here's the important part, rough credit, and they're getting themselves out of rough credit, the first thing they do is cut up their credit cards. That's the worst thing they can do, because yes, they may not trust themselves, but if you've got rough credit and you cut up your cards, the ones you cut up may be better than the ones you can get.
Exactly.
So you have to trust yourself that I'm only going to buy what I need, and then I'm going to pay for that.
Okay.
Every month. If you have a history of getting on credit cards and not paying them off every month, your first thing is to try to get the cards you have to the point where you pay them off every month.
Right. Well, let's talk about, because we're in a changing economic environment, and there are many, many, many very solid individuals 4 years ago who are now finding themselves literally pulling hairs, trying to keep things going. And I know their credit is suffering. People are doing minimum payment because that's all they have. Are there any recommendations that you can make?
Well, to back up on that issue, yeah, it's really bad, because here's the problem. If they're having problems and they're paying minimum payment, what many people are doing, just trying to pay their bills.
Just trying to get through.
The problem is the credit card companies are lowering people's credit limits, aren't they?
Yes, they are.
So if you have a credit limit for $5,000 and now they've lowered it to $2,000 and you owe $2,300, your scores are going down.
Because you're over the limit.
Well, not only over the limit, but the basic credit guidelines are how your longevity, the type of credit, and it's called open to buy. On any credit card that you have, you want to keep your balances at 30% of your limit.
Okay. That's important, because I don't think people know that.
Well, in a perfect world, there's a lot of
30%.
Right,
Yeah.
30%. In a perfect world, we're all trying to just pay bills. I understand.
Right.
But if you're starting out or you have existing credit cards and you want to improve your credit, when you run a credit bureau, it doesn't say Rich Ambrose makes this much money a year,
right,
or Michelle Graves makes this much money a year. No, it doesn't ask you what you make. So it's a matter of your credit history, how much open to buy you have. If I've got 5 credit cards, a car loan, and a house, and so do you, and my credit cards are $22,000 limit, and I owe $5,000,
right,
and yours are $7,000 limit, and you owe $5,000, my scores are going to be higher.
Your scores are definitely.
Most likely.
Right.
If we're both the same age.
Right. All things equal.
All things equal.
Right, right.
So there's a lot to credit. The most important thing is baby steps. Get credit and pay it.
On time and as agreed.
And if you don't and you get into trouble, there's ways to get out, and it's not, you know, I run into many couples, man or woman, got divorced. That's usually a problem.
That is. Or medical.
Medical collections, that's a problem. But when you're divorced, then you say, okay, well, I'll never get married again, and you let your credit go. When you meet somebody, happens a lot. Now, Rich, I need your help. Okay, here's what we got to do.
Okay.
You know, so if even...
So what do you tell them?
Well, I look at their credit and see what their 3 scores are. We'll do an in-depth credit report for no charge with a realtor referral or like your referral or past clients or whatever, or customers call in. And I look at their credit report. And if they've got for instance, a 589 credit score, middle, because they got 600 and 540 and 589, and you take the middle score, then we got to go to work, and they
Yes,
and
we
they
do.
got to. I'm not a credit counselor, but I tell them this is what they need to do, you know, and we start there.
Okay.
A large part of that is to maybe fix some things that are not paid, and which ones to do first.
Now, if a person, when you go to do their a full credit report, and you look at unpaid obligations such as that, do you advise them to negotiate to get it paid as it wouldn't be paid in full, it would be a settlement?
It depends on if they're past due or if they're a collection.
Okay.
So if they're a collection, like I said, I'm not a collection credit counselor or anything
no,
like
you're not,
that.
right.
But if it's a collection and it's 5 years old, and it's been reported recently where they're still hanging on to these poor people, right?
Yeah,
okay.
they do. Yeah.
Then you're going to have to settle that the best you can.
Okay.
And that's what you want to do. But the older stuff you leave to last, and the collections are not as powerful as one 30-day late payment. You can be sailing along, and all of a sudden you get a 30-day late payment because someone got ill, someone got hurt in the family, or whatever the case may be. Can drop your score 70 points.
That is so.
One.
You hit it right there, Rich. One, where it didn't post on time. And like it or not, the U.S. mail system is a force to be reckoned with, unless you're internet. And if you're internet, that's a completely different world. But if you're counting on payments going by mail, I just feel very strongly that people need to know that as soon as you get the bill, you need to pay it.
Right. The bill,
Right
like your
then.
home. It's like your home. The bill's due on most good loans the first of the month. You got 15 days grace period.
Yeah.
And then you got 5% of your monthly payment late fee on conventional, 4% on FHA. And people say, well, good, I can pay it the 10th or 11th. Or No. Try to get used to taking advantage. When you set up a purchase loan or a refi,
Yes.
what happens? You have interest till the end of the month and no house payment the next month.
Right.
And if it's a refi, you're paying less money anyway.
Right.
So when you get your first notice of where to pay your bill, you start paying it the end of the month before the first of the month.
Right.
What the big reason for that is if for some reason somebody doesn't post your payment, you're likely going to know about it before the 15 days where you get a late fee, and for sure before 30 days.
Right.
Where it's going to hit your credit.
Right.
It's not until you're 30 days late does it hit your credit.
Well, the thing about it is actually, and this is something that over the years people have had a difficult time understanding, interest accrues in arrears.
Exactly. You pay
So when it's due on the 1st, that's for the previous 30 days.
Exactly.
So literally, if it posts on the 2nd, you are late because the 30 days prior were due on the 1st.
Well, in literal terms, yes.
Right,
But you got
right.
bills due on the 1st, and you got a grace period. So why pay under the grace period? Because that grace period is really there for a problem.
Exactly.
Is what you're
But I
saying.
think that a lot of people don't know, because I remember when I did what you did, and one of the most difficult things to deal with as an underwriter was, how do you get them, because they paid all of their mortgages late, meaning within the grace period, but it's due on the 1st. And then you sit down and you said, you're supposed to pay the bill on the 1st with your mortgage. They said, no, but I have a grace period. I said, there's no grace in banking. It's no grace. It's due on the 1st, you pay on the 1st, and then all things well. And we really had, I just found that to be an area that people were not clear about. They did not understand. So as a rule of thumb, my position is that if it's due on the 1st, it needs to post on the 1st.
Well, in literal terms, you're right. I mean, there's a lot of things that I can tell you, but one thing is, let's say you're doing a mortgage loan.
Yes.
And you're a teeter-totter, and they do a verification of mortgage. And
okay, now define what a teeter-totter is.
Well,
okay.
let's say you're on the fence of not getting the loan or getting the loan.
Yes, okay. It's an underwriting piece then.
Yeah, and they do a verification of mortgage so that they figure out what you owe,
right.
and if you've been late by 30 days, because maybe it's on the credit report, but they want to know how you paid your bill.
Right,
Like you were
right.
saying. And if it shows that you were constantly paying on the 14th of the month, which many well-off people do,
but
unfortunately.
I'm serious,
but that might
Rich.
make a difference.
Yes.
Might make a difference.
They just consistently, because there is not enough, our industry, and I have to say it having been in the industry for 30-something years now, our industry has a way and a culture that is not very well understood by the average working person. And not even the average working person, affluent people as well. They don't teach banking in high school, Rich. They don't teach how to write a check. They don't teach about the various conduits that you can deal with a bank, or, you know, today they've got all kinds of alternative banks. They've got green dot cards, which is huge among young people.
Well, let's talk about debit cards.
Let's talk about debit cards.
You know, my company gives debit cards, but if you're young and you're growing your credit or you're replacing your credit, you want to use a credit card.
Right.
And pay it off. Because when you use your debit card, okay, I just used it, $10, and but it comes right out of your account right now.
Right.
Instead of using a credit card, it comes out in 30 days, and if there's a problem, you can get it taken care of. And also, if you lose it, you can get it taken care of.
Right.
There's something I want to bring out before I forget, though, it's on my head, is if you ever do a loan for a car or a house or whatever, and you're getting cash, some way, shape, or form, and someone says to you, don't pay your house, don't pay this, don't pay that, we'll take care of that. Well, if they don't take care of it in a timely manner and it goes on like another week or two or three, you've just crossed a slippery slope, and they might have just got you in a catch-22 position. And that happened years ago with some of the non-conforming, real subprime type lenders.
Right, exactly.
They didn't really worry if they made you worse because they would just make more money.
Exactly, exactly. But we're in a different world today.
Can't do that anymore.
And you cannot do that. I would like to say that after 2008, with the collapse of Lehman Bank, and as well as Bear Stearns, the New York investment house, and the implosion of the banking industry from all that bad paper, globally, bad paper.
Goldman Sachs made money off of egg.
Goldman Sachs made money, and Goldman Sachs is making money today. But there were a lot of casualties, and the biggest casualty, I think, was the American people. That's my own personal opinion, that the American people having underwritten all of this. And I mean, it is what it is, but you know, I think the American people have suffered. So here we are today, and as we're moving forward, I would like for you to talk to me openly for the benefit of our viewers. What if a person comes in, and we've talked about if their credit is not the best, but they can, if they follow your program, they can get themselves back on track within 12 months. Is that realistic?
Well, it depends on how
severity?
bad somebody is. So
Okay.
maybe somebody's just bad enough that we got to take 6 months. It's really hard to say.
Okay.
And again, I'm not a credit counselor, and we're not a credit counseling outfit.
No, you're a bank, right.
And you know, but each case is different.
Okay.
And that's the question everybody wants to know when I say, you know, I can't help you right now, but if you do this, this, and this, you know, they can hire a company to clean up their credit. Sorry to say, but most of them don't do a very good job because they live under the rule of 30 days. In other words, they're going to send information to a company that you owe money to, and if they don't respond in 30 days, they have to take it off.
Right,
Problem is, you're paying them $500, they get it off, but for about 30, it pops back on.
Right.
So I'm here to do mortgages. If I can't help you, I'm not going to say, can't help you. I'm going to say, I can't help you now.
Right.
But let's structure you, and this is what you need to do.
Right.
And if you do that and some other things, then you're going to be fine for not only a mortgage as time goes on, because it takes time. If you have bad credit and you owe everybody's past due, to make an easy analogy, and you pay everybody off, your credit's not perfect. And a lot of people think that's the case.
Right.
That, okay, I've just paid everybody off.
But now we need to see a history.
But now we want to see a history of you paying
moving
your
forward.
bills.
Yeah.
That's the important thing.
Yeah.
And the other important thing is there's some people on, you know, Dave Ramsey. I mean, he's all about paying off credit and do that. That's fine.
but I don't agree with some things.
Okay.
Okay, and we'll maybe talk about that, a 30-year loan versus a 15 and things like that. But the most important thing is when you're paying off your credit and you're trying to build your credit or whatever the case may be, and once you run into that trouble where, okay, somebody's going to help you, I'm going to help you, you're in bad shape. And they say, pay these off and cut them up. Now, I've said it before and I'll say it again. If you cut up your cards and you can't get any more credit, you just did yourself a disjustice.
Exactly.
You have to trust yourself. And I've said that to many people. You have to trust yourself.
Right. Can you responsibly handle?
To take those 10 cards that you, instead of cutting up, here's 8 of them, I'm going to put them away for a while.
Right.
I'm going to use these 2 for 30 days. Then I'm going to take them, put those back, I'm going to use these 2. And why do I say that is because if you don't use a card for 2 or 3 years, it's not giving you much power. So you want to use it, what I call exercise it,
right,
and pay it off.
Right.
So
even if their annual fees, it's just worth it to pay the fees to at least have the access to the card on a yearly basis, correct?
I don't have a card with an annual fee, and I don't recommend that. But if you have to have an annual fee, you have an annual fee until you don't need an annual fee.
Right.
You know, I like the cards that some people want the rewards and some people want the cash.
I don't care.
Yeah. Well, if you use it and pay it off every month,
yeah,
that's if you can get to that. I keep saying it. But if you can't, you can't. But just pay your bills. I mean, in order of importance, they're all important. But on the hammer of your credit report, it's your house,
yes,
a home equity line of credit, second mortgage. Some people even have a third mortgage today, believe it or not.
Are people doing third mortgage?
No, well, they're out there still.
Wow.
Kind of left over.
Okay. Are
And
these
then-
old? Is this old paper? Or
This is old paper. I just ran into one the other day.
Oh my gosh.
Most people, by the way, don't think a home equity line of credit is a second mortgage.
They don't?
Most people honestly
But you know
don't
what,
understand
Rich?
that.
It's deeper than that. If you have a home and you have a line of credit, that is a first mortgage.
You're a second mortgage product in a first position,
in a
aren't you?
first position.
Right.
And people don't understand that either, which is, well, that's actually, they're in first position.
Yeah, and you know, we kind of got off that last subject a little bit, but it's important. You know, a home equity line of credit, let's say you have a $100,000 line. And let's say you owe $80,000. Believe it or not, there are people out there paying off their first mortgage first or paying it down first and leaving their home equity just because it's cheap right now. You know, it's 3 1/4 is prime. You know, prime plus 0, 3 1/4 if you got real good credit and you got 80% or whatever.
Yeah.
Which is 80% of what your value of your house is.
Right.
But some people end up with a second mortgage owing way more than their first mortgage. And they think that, okay, maybe I have a $100,000 line, I owe 80 on my first, and I got a $100,000 line.
Yeah.
Right?
Yeah.
And they use it for college.
Yeah. Oh, yeah. People leverage that line of credit. Yeah.
The next thing you know, it's 100, and this is 80.
Right.
So that's when you need to think, oh, well, maybe even though I'm at 3 1/4 or whatever here, and I'm at 5 here, how about if we combine them? Let's see if we can combine them and get them at a 30-year fixed at 4 or somewhere in that area.
That's excellent. Do you do that?
Yes.
Okay.
I do anything that's a purchase or refi from 4 family on down personally.
Okay. The issue of them having that line of credit, because many, many people use LOCs, HELOCs as we call them. But the thing that always troubled me about HELOCs, because I'm an old woman, I may look good, but I'm an old woman.
There you go, you said that.
But I remember when Jimmy Carter was president, and do you know that HELOCs are variables? And in the contract, I think the HELOC can go as high as 20%, something like that. It's in.
Yeah.
That's the first.
Well,
thing.
that's the key. You just said the key there. I can't let that go. Variable. It's not a fixed. It's not adjustable.
Right.
So when the prime was falling, everything was great.
Right.
But when the prime starts to rise here one day, your rate will change every day. So you just have to keep that under control. It's a good time to have a HELOC. Everybody should have a HELOC.
Right.
But our HELOCs have fixed rate lock options, you know.
Oh, you do offer a fixed rate?
Fixed rate seconds or a home equity line with a fixed rate lock option.
Oh, that's very nice.
Yeah, I don't do those again. Our branch manager does them, but I refer them to them.
Right.
Or I do SIMO seconds, like I'm doing one where you have an 80% first,
okay,
that's 80% loan and 10% down,
okay,
and a 10% second,
so you don't have any mortgage insurance. We still do those.
We still, because
we
that
still-
was a subprime product though in the day.
Well, because
Rich, yeah.
it was, well, there was a lot of first mortgage good.
Right.
Because it was good
Right.
HELOCs, not,
Right.
not high first and high seconds
Right,
for variables. But
right.
a home equity line, you have to be careful. It's a great product. You need to be able to have money for emergencies. It is variable, not adjustable.
Mm-hmm.
Or you can do some people have a fixed second.
Okay. But ideally, since it's a collateralized instrument, you're still talking about a second mortgage on the home. Wouldn't it make sense? Well, I guess I can see that. If they have a $100,000 HELOC and it's completely leveraged up to 100, and it's a variable product, I would want to see that into a first.
Well, yeah, if you got before you go to the, let's say you get a $100,000
Yes.
line, and you got a $100,000 line in 2007.
Yes.
You know where I'm going.
Oh, I know where you're going.
And you had put 20% down on your house in 2007, and
Yeah.
you got a 10% second.
Yeah.
Okay, and say whatever that line is, it doesn't matter. But now the house is worth 20% less. You're underwater, so you couldn't combine them.
You're right.
So on your way to using your line, if people spend as much time looking at their finances or talking to a trusted advisor as they do watching sports, or at least 5 minutes of that.
Yeah.
And I like sports, believe me. But you said something earlier. We need to spend time on ourselves financially.
Yes.
You know, and I don't want to beat a dead horse, but you got to
It's
have
not
good
being a
credit.
dead horse.
But you got to have a good credit.
Good credit is everything.
And you want to know some basic, you want to know how to play a game, you need the rules. Well,
Right.
The rules are loan to values and credit and job time. There's only 4 pieces of the puzzle, but it's funny how your job time, your income that creates debt to income ratio, and your credit and the appraisal you can't control.
You
especially.
cannot.
So, but there's only 4 pieces of the puzzle, but everybody's got a different story.
But that's what I can't.
And that's that's where we come in. We
Yeah,
try to fix.
yeah.
We try to. If you're easy, you're easy. Done.
Yeah.
Well, actually, there are no easy loans anymore. We say.
I was going to say, my goodness gracious, talk about all kinds of animals in the playpen.
Yeah, and
there's everything.
Along
out
with
there.
the credit thing, don't forget now. There's another new thing we do that drives us nuts. Is
What's that?
We all do in this business. I'm sure every company, I think, is 3 days, 5 days before closing, we pull credit again.
Oh,
And if you went and bought
stinky.
If you went and bought something like a bed or a washer and dryer, which would be normal, you're going to buy it later anyway.
Yeah.
But if you have it, we got to put it. We got to do an inquiry. They're following rules today on credit, like inquiries that was out there for years, but we didn't follow.
Right.
Anything
right,
within
right,
120
right,
days, we got to
right,
explain what it is.
Right. And then it has to go back to underwrite again.
Well, they got to sign. We might be approved with conditions with an
Yes.
inquiry or something like that. Now, so
That's important.
it's all important.
Because you know what is a funny thing, when I owned a mortgage bank, I had a couple, I'll never forget it. They had been approved, pristine, all the above. Do you know, to celebrate buying their new home, they went and bought 2 brand new Cadillacs a week before the loan closed and put their debt ratios out of whack. And what was a conforming Fannie Mae loan became a turn down.
I understand that.
Yes.
And I'm sure you mentioned to them that don't buy anything.
I
And-
surely did. And they said, we were so excited about our home, and we went out over the weekend and we bought matching Cadillacs. And I looked at them as if, you have got to be kidding me. And they did, and the loan was denied.
Yeah, you know.
Going to closing, denied. Did a pull-up. The investor wanted to do a final pull-up to condition. And as the underwriter, that was done. And it went from an approved loan to a turn-down.
Debt to income ratio.
Exactly. So I share with people, and I'm sure you do as well, because I'm definitely not on your side of the fence anymore. I like looking in, but I don't want to play. It's very important to be mature. And when you said about the time you spend looking at television and sports versus taking care of your own affairs, and that is an area that I really feel that people need to know, which is that we live in a time where it really is about taking care of your own affairs. Nobody else is responsible for the situations or the decisions that you make, good or bad. It's your ship. And so I think what you're doing and trying to do with education is so very, very powerful with those who have the potential. Let's talk a little bit about self-employed people, because again, with the economic shift, with so many people losing their jobs, highly compensated execs and regular working people, and going into the world of self-employment, which I encourage, Rich.
Which more and more people are doing because of the hard times.
Yes.
And before I go there, let me just drop this in a little bit, a little blitz drop here.
Okay.
Yeah. And the reason why I say this is everything we're talking about, if you're going out to buy a house, don't fool yourself. If your realtor isn't a pro and doesn't say get pre-approved, you need to get pre-approved so you're in a position of power.
Thank you very much.
And you know where I'm going with this.
I know where you're going with this.
Maybe 5 out of 10 loan officers make me look even better because they take a little bit of information and give somebody a pre-qual letter to make the realtor happy.
Yes.
That doesn't do anybody any favors.
No, it does not.
And I understand everybody wants to sell a house and make money and all this. I understand all that. But the person, the borrower, doesn't really realize the ramifications when they're not really pre-qualified right, and I try to pre-approve everybody. Because when people say, I've been pre-qualified, I said, great, have you turned in your W-2s and tax returns and pay stubs?
Exactly.
No, why do you ask me that? Well, then you're not pre-approved.
Exactly.
You might not even be pre-qualified.
Right, right.
So when we're talking about buying a house, we're talking about refinancing too. You do the same thing. You want to make sure it's going to work. But when you're going to buy a house, you need to be pre-approved by a person that you trust. Someone that they refer, that's fine if they're darn good. If they're not, get your own person. Okay? But pre-approval is powerful. That means I want to go out and buy a house for $200,000. Can I be pre-approved at that? Well, I'm going to pre-approve you for $220,000 then if I can, because I know you might want more.
Yeah.
And I'm going to pre-approve you for a larger loan amount if I can and a higher rate than when we're at today. Because it may take 90 days to buy a house.
It may very well.
So if I approve you for a little more, the easy thing is to buy less, right? That's what you want to do. You know, I may tell people that, yeah, you're pre-approved for $200,000, but what's not on your debt-to-income ratio may be your Catholic school education, private school education, or daycare.
Right,
you know.
those expenses.
So before we get into self-employment, a little tidbit, when you want to buy a house, as you know, get really pre-approved. Do yourself a favor. And if that person that you're working with now doesn't do that, you want to do it. If you haven't turned in your pay stubs and W-2s and tax return, and they haven't run an in-depth credit report, you're just getting somebody's opinion.
Right, and that doesn't work in underwriting.
No.
Well,
what happens is you may go out and buy a house, right?
Right.
You think you're going to buy one.
Well, you put in an offer, yeah.
You put in an offer. Let's say they accept it. They need the letter. That's why they did it. Might not be good.
Yes.
You do a whole house inspection, a termite, and an appraisal. You spend $1,000 today.
Yes.
$300 for a whole house, maybe $50 for a termite. Now about $400 for appraisal. And maybe maybe you had to pay for a heating and air check.
Right.
Or whatever.
Right.
Why pay anything until you're pre-approved?
And you know what, and it's so funny you say that because many, many years ago, that was my real thing, which is you need to be pre-approved. I didn't want to start a war with the real estate community because they're powerful.
Right.
But I did not like bogus, these pre-qualification. What the heck does that mean?
Right.
You know.
Yeah, have you turned anything?
Have you
no.
turned in
what's
anything?
It worth?
Then what's it worth? And why is a realtor running around showing you real estate and you don't have a deal? And I could never understand it. Maybe that's my Wall Street training because my whole thing is either we got a deal or we don't.
So you've heard this before. Would you go have heart surgery without the insurance being
taken
approved?
care of something?
No.
No.
So if you're going to buy your biggest asset, I tell people every day, and the people out there that may watch this someday are going to hear this, you're not buying a shirt. Because a shirt you can take back. You're buying a house.
You're buying a house.
Let's do it right, get you in a position of power. So once you are, boom, go buy what you want. The realtors, a good realtor is like a good mortgage person. They're great.
They are.
They're going to take care of you. They're going to be, you can't teach people to care.
Right.
You got to know from experience when someone cares.
Right.
So if I care enough about you to get you pre-approved, they care enough about you to get you buying within your means too. What you want, show you a few things. That's important. And you know, they may take somebody's word that they're pre-approved, and they might not ask if you've turned in papers. You know?
Yes, right,
You know,
right.
a lot of
Because people don't understand terminology, but
Right.
most seasoned at this point in history, we're not talking about 40 or 30 years ago, today, should know pre-qualification versus pre-approval. And the really top-notch full-time realtors know trusted bankers,
Well,
mortgage bankers.
The reason I say that is the real pros don't show anybody anything until they're pre-approved.
I totally agree.
And hopefully by someone that they trust, you know. The other thing is, but there's a lot of this, because you talk about young people.
Yes,
They don't kind of understand the way we did things.
I know.
They get on the internet,
That's
they
what
see
I
a
was gonna
house,
say.
they
Da, 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 da,
call,
da. Yeah.
they go see 5 houses, and there's 5 different realtors, and they're all trying to get them to be their, all the realtors want them to be their realtor.
Right, right.
And they're running around, before you know it, nobody realizes they're not really pre-approved. Oh, I called, I won't say a name, somebody on the internet, and they say, and they think I'll be okay.
That's not good enough.
Well, first of all, most of those on the internet will not give you a clear to close letter.
Right, right.
But-
Subject to, yeah, yeah.
But that being said, pre-approval, you know, my second oldest daughter is getting married, Kelly.
Oh, congratulations.
You're having a wedding in September, and we started this over a year ago.
Okay.
So I tell people when they're going to buy a house, you should think of it as a wedding. If your name is Smith, Jones, Powell, Johnson, you need to get pre-approved, so in case there's any credit bleed over, right?
Exactly.
Maybe not
Exactly.
as if you're, you know, Graves or Ambrose, but still, think of buying a house as having a wedding. Start at least 6 months ahead of time, because if you're good then, you're good now. But if
Right.
you're not good, it may take 6 months to correct a problem, because credit isn't corrected over a
No,
month. It takes
no.
problem. People say, how long, Rich? A minimum of 6 months.
Right, a minimum, a minimum.
You know, and the biggest, or probably the neatest story I can tell you about credit, and I know he won't mind, is my son-in-law. And you know, there was some things there. All the while they went out for years and years. I said, if you need help with credit, let me know. No,
Okay.
I'm fine. I'm fine. And I'm sure he didn't want me to delve into it.
No, he didn't.
But
no.
I said to my daughter, once they got engaged, okay, he's part of the family. Tell him we need to get his approval to pull credit.
Yes, yes, indeed.
Because I want them to have the
indeed.
I want them to have a house someday. You know.
Absolutely.
And
Absolutely.
yeah, I found problems. And yeah, his parents and my parents, we got it fixed. But it took, by the time they got married, and then if they rented a while, then they got a house. So it took,
And that
it
is
took
a
a while.
logical progression, though,
Yeah,
Rich.
I would say an
I
average
think
of
so.
12 to 14 months to
Yes,
correct things.
yes, yes. But I think that's a good story. Particularly today, my concern in the mortgage banking industry is, given what's happening in the economy and the number of young people that are adversely impacted from student loan debt. I mean, come on, that's real.
That's why we're talking about credit, because credit is, you know, with everybody being out of work,
Yes,
they're missing payments because they can't help it maybe. They're lowering their limit, they're canceling it by the grantor. Okay, so
Yeah.
I mean, and I know maybe somebody should sit out there saying, okay, enough about credit, but that's why we're talking about. We know that it's so important
right.
for everybody, and there's help there. There's all kind of help out there for credit. Biggest help, annualcreditreport.com.
.com.
Right, that's free. It's I think
And they
the
need to be
government backs
careful,
it.
because that is the only venue, annualcreditreport.com, that will allow an individual to pull from all 3 reporting agencies free. Now, they don't do credit scoring,
Right.
but you do have an opportunity to look at what lenders are looking at, which is so important. I tell people, why don't you want to see what we're looking at?
Well, we use that because if I pull credit, there's a problem. Then time goes on. We get them doing things after 6 months, so that they can do it again in 6 months themselves and see if there's anything on there that should have been paid off. You may pay something off, but if you don't document who you paid, the account number, and that it's paid to zero,
Right.
and these people take your money, but they never report that it's paid,
There you go.
it's still there.
Right.
It's funny to say that maybe when people say every day, I paid that off. I'm sure you did. They're really quick to report you haven't paid it, but they're not so
Right.
quick to report that it was paid.
And the consumer has to be their own advocate, wouldn't you say?
Oh yeah, it's like your
regard to
best
these
patient
things?
is yourself. The best person to watch over you at a
Is
hospital
yourself.
is yourself. It's the
Exactly.
same way when it comes to your credit.
Right, right.
And-
so let's shift and talk about self-employeds,
Yeah.
because that is my area of specialty actually was underwriting self-employeds, but that's a tricky little group.
And how much time do we have? Because I got one more thing after
Well,
that.
go on and talk.
Good.
We got a
Well,
little bit.
self-employment is people say, well, I'm self-employed. Is that a problem? No, it's not a problem. It is what it is.
It is what it is.
And basically, how we deal with self-employment is very simple.
Okay.
We take a 2-year average of their tax return, usually on line 12 or 17. That's your adjusted gross income. 17 is rent, royalties, and partnerships, or 12 is self-employment.
Right.
We take a 2-year average of what you show the government. So if you gross receipt $500,000 and you show the government that you've lost $12,000, then we don't have any income to use.
Exactly.
Gross receipts is one thing, and everybody likes to tout gross how much money they brought in. Okay, so, but there's other things to it, and I don't want to profess to be the expert, but there's if you own property,
Right.
depreciation you can write off. You know, and self-employment is basically you got to be today, not like
Right.
everything's harder today.
Right, right.
2 years of tax returns. And granted, if you're self-employed and you make money in 5 years, you're doing good. So don't expect too much if you just become self-employed.
Yeah.
The important thing to know is this: if you were W-2 income, okay, and you're engineering widgets, and now you're making those widgets under self-employment,
Right.
and you just started that 6 months ago, you can't do a loan.
Right.
But if
Even
you're
a
self
refinance.
right, but if you're well, at least unless somebody's willing to hold your paper, of course.
Right.
But if you're self-employed, being engineering and making widgets for 10 years, and then you go to work for the widget company under a W-2 employee, you're okay.
Right.
Okay.
Right.
But going from W-2 to self-employed, if you're thinking about being self-employed, make sure you got plenty of money to back you up and do what you need
Right.
to do.
Which is
'Cause
actually what I counsel people, which is the whole world of self-employment. You cannot be arbitrary about that move. You have to give it some forethought, and you have to look at what your money, your cash flow is looking like, and if you have a home, because a lot of people get laid off or lose their job or downsized, and then they want to start a business and they want to leverage their home. And you know this. I'm not telling you something you don't deal with. And so what happens? They're now officially unemployed, but they're starting a company and they have a home where they have significant equity. Now, given that scenario, what do you do?
And how long have they been self-employed?
Oh, maybe 6 months.
Not much I can do.
Right. Even if their house has equity.
Yeah, even if that's another story. Yeah, that's why I tell people now sometimes, get your money out while the rates are low, because if you wait 3 or 4 years when you need money because you know, and you don't qualify and the rates are higher, it's a little another story. But back to this self-employment.
Okay.
The other thing that goes along with that is this. This day and age, there's a lot of people going to work, coming home, going to work, coming home.
Yes.
And in between there, they have, you know, they have some self-employment business. They're doing something to try to make some money. And today what they're doing, what we've run into, what we're doing now, we are doing, is we have to get tax returns no matter who, because we've got to see if they've lost money selling something on the side or doing anything on the side.
Okay.
So if you're W-2, 60 grand a year or whatever the case may be, but you've got some self-employment little business going on and you're showing a $25,000 loss, that's going to affect your ratios.
You're right. This has been fascinating. We've got, time is running out fairly quickly, and I just want to make sure we've covered, in the remaining time we have, some areas that you'd like to talk about just quickly.
Yes, I would like to talk about a program that we have. It's a CRA program, community program.
Community Reinvestment Act.
Yeah, it's a program we're doing that it has, if you make 80% of the median income,
Okay.
median income's about $73,000, so if you make about $56,000 or less,
Okay.
and you want to buy a house and you're a first-time home buyer, we can do that with 5% down and no mortgage insurance.
Whoa.
Better than that.
That's better than FHA.
Oh yeah, well yeah, by a long shot.
Yeah.
Because FHA, I wanted to touch on that.
Okay.
If you are making $100,000 a year, but you buy a house in a targeted area, we can still do that.
With the 5% down.
5%
no
down.
mortgage
It's
insurance.
called, right, we call that the CHAMP program. And it's 5% down, no mortgage insurance. 80% of the median income if you buy a house in a normal area, or if you're buying in a targeted area, then the income limits are off.
And let me ask you, does this apply for refinancing as well, or is it only purchase money?
It's mainly purchase money. We
Okay.
have one little blip in there about refinancing, but I can't even remember that, so I
Okay.
won't go there.
So it doesn't matter what your industry is. This would include nurses, policemen, and any industry. Doesn't
Right.
matter.
But you
As
gotta
long
make
as you
less
make
than
that,
80%.
that 80%.
Or a lot of people, we're doing a lot of loans. If you're buying a place in a target area, like a $200,000 condo downtown,
Yes, yes, yes.
we're doing those.
Oh my gosh. What's your phone number?
582-5616.
Give me the area code.
513-582-5616. Yeah.
That is 5% down, no mortgage insurance. If you're in targeted zones, then it does not matter what your income is.
Correct. You have to have a 700 credit score.
Of
So
course,
again,
credit is
yeah.
credit. 700 is excellent credit.
And why is that important? Because today, FHA we're still doing, but they've doubled almost what their PMI rates. I won't get into numbers and bore people, but it's 1.75% up front. And
But
it's
is FHA solvent, Rich?
No, they're not. They're wanting to get out of the mortgage lending.
They're certainly getting out of reverse mortgages. I can assure you of that. They took a beating. They found out that the elderly won't pay their taxes, won't pay their homeowners. And of course, everything went underwater. But that is a phenomenal program. Let me make sure the CHAMP program, you're the point person. And this is really a targeted program. However, if you're in a targeted community, there are no income restrictions.
Right.
Is that a fair statement?
Right. If you're in a
Okay.
targeted community, no income, you have to have a 700 credit scores. You can put 5% down, no mortgage insurance.
Wow. Viewers, this has been a great show. And with my guest, Rich Ambrose at First Financial Bank, and where he brings to the table over 21 years of mortgage lending experience. He's the guy that's my guest, and I happen to like him, and I think he's a seasoned player. You know, if you watch me, that I'm only interested in people that know how to play this game, and they know how to play it powerfully and successfully. So I am delighted to bring him today and to wish all of you that tuned in the very best of success. We're in challenging times. Tighten up your game, learn how to play by the rules, and then play to win. I'm your host, Michelle Graves, the Money Lady, welcoming and wishing you an amazing day, and God bless you.
Thank you.
You're welcome.
Thank you.